All right there. So cool. So that's that. So, yeah. So the impact. So you could do this with tuition, books, cars, commuting, up to $10,000. So before you had to use a Coverdale ESA. Now you can use your 529 plan and you can use up to $10,000 for K through 12 activities, either public school or private school. And again, there's no annual federal cap. Now gift tax rules apply, but gift tax rules up to now $23 million. Ain't nobody hitting that, so that doesn't matter. But it is no federal cap though. Again, the higher withdrawal limits, like I talked about. Oh, I went backwards. So yeah, that's that. Also, as well, with a 529 plan, before we could only do $13,000 per parent per year. So if I'm a parent or a grandparent, I can put up to $13,000 a year. Two parents, 26,000. Now with the big beautiful bill, they increased that to 18,000. So now I can do $18,000 a year per parent or 36,000 tax free. It's pretty cool. And again, that money grows if we use it for college or now educational expenses in general. We take that money out as tax free. And also some states, like here in Florida, the great state of Florida, from a tax standpoint, tax free, they allow you to actually do a lump sum, right? So we actually had a conversation last week with a client. I don't know if they're going to do it, but they received a pretty nice size inheritance. So we talked about from a college funding standpoint, instead of doing the 529 plan over years, we front load up to $90,000 because $90,000 at once, growing tax free, is a lot better than doing $90,000 over 5 years tax free, right? Because you have a lump sum of money that should grow more over time than increments of money, right? So now you can front load or you can put up to $90,000. So if a person receives an inheritance, receives some type of life insurance, has some type of sum from the house, they want to put it from a college funding standpoint, then of course they can front load and put up to $90,000 instead of doing that $36,000 a year. So yeah, so that is that when it comes to a 529 plan. Any questions on a 529 plan or educational plans before we go over other things in the big, beautiful bill? And again, you can either ask the question in the chat or you can unmute yourself when it comes to 529 plans or the changes in 529 plans, or how we can implement that if we're a business owner. Okay, cool. All right, thank you, Beverly. Appreciate that. All right, so the next thing in the big, beautiful bill is charitable giving, right? So we now can give more to charity and get more write-offs for it, right? So universal charity deduction will return even people who don't itemize. This is important. So for our seniors out there, the individuals who do not itemize, because some people do standard deduction, and now the standard deduction is higher as well, which we'll talk about for our seniors. But now if you don't itemize, you can do more charitable gifts and get more money back from a tax standpoint. And it goes now from 100% AGI to 60, well, it was 60% AGI, now it's 100%, which is your adjusted gross income. So we have AGI, MAGI, or Maggie, not MAGA, but Maggie. So adjusted gross income, kind of what you receive. And then your modified adjusted gross income, which is what we see kind of after deductions, right? So it's based on the top number, which is good deduction-wise, not the bottom number. So what can we do? So we recommend anybody who wants to do any type of donations, you can use what we talked about a few weeks ago, a charitable living trust. The issue with a charitable living trust, though, is that it's irrevocable. Once I put money into a charitable living trust, can't make any changes. It is what it is. Or you can do what you call a donor advised fund. And I was going to talk about it if people don't know what it is, but put a one in the chat if you are not familiar with a donor advised fund. So if you haven't not heard what a donor advised fund is, you never heard of it, or you're interested kind of what it is, then put one in the chat and we can definitely explain that, because it is a way for you guys to have control on something and get a huge tax write-off because of it, if you do it properly. Okay, cool. All right, so yeah, so we'll talk about that. Okay, cool. Because y'all know, because we have a lot of people in here. So yeah. So the tip. So layer donations in a donor advised fund to give now and decide how to give it later. It creates a lasting legacy when you maximize your current documents. So you're able to put money into an account. Well, actually here, I think, okay, cool, yeah. Oh, yeah, great. So a donor advised fund, we look at it as like a charitable checking account. Now, of course, from an investment standpoint, we recommend not to do it in a savings or money market account. Invest it, right? Because you can contribute cash and stock Cryptocurrency, if it's in the stock market, so like symbol IBIT, symbol FBTC, those are Bitcoin ETFs you can buy on the stock market. EETH, that is Ethereum stock that's tied to Ethereum. You can buy on the stock market, so you got to worry about somebody stealing your Ethereum, like it's original cryptocurrency. Now they have Solana. So if you guys want to get some of those riskier cryptocurrencies, Solana, the symbol is SOLZ, where you can buy Solana directly on the stock market, and then XRP, symbol XXRP on the stock market. So you can buy these cryptocurrency investments if you want to on the stock market and put it into a donor advised fund. You get an immediate tax deduction for the full amount. So if I put $10,000 in a donor advised fund, it's like I am donating $10,000 to a charity or a church. I get immediate tax write-off. So if I made $100,000 per se, I put $10,000 in the donor advised fund. Now I'm taxed on $90,000, not on $100,000. All right. And so we recommend where the money is donated, so you get to also decide when they get the money. So with a charitable remainder trust that we talked about, once the money's there, it's there, you have no control. With a donor advised fund, even though it's in that fund, since you're the donor, you get to advise when the money is given, right? Because you have full control. So you get all of the tax write-offs, like it's a charitable, trust, irrevocable, that you can't make the decisions on. But with the donor advised fund, you get all of that freedom to decide, and then also you get to extend it to somebody from a charity standpoint when you want to. So you basically have all the power in the world to do that. So real example, the conversation we had yesterday, I always like to use real examples. I'm blessed to, help thousands of people, across the world. A real example. So we talked about doing a donor advised fund and kind of when, right? So this person, they're thinking about donating now $50,000 in stock. 2 years ago, it was $25,000 worth, but because again, the investments we've done, that's basically doubled over 2 years. Now it's $50,000. The cool thing about a donor advised fund is that since you are able to dictate when you put it in, we recommend you don't put it into that account when you first buy it. You put it in when it appreciates. Because if I have a basis, if I bought a stock for $25,000 and now those stocks are worth $50,000, if I put it into the donor advised fund when it's worth $50,000, I get the full $50,000 of write-offs. Compared to if I put $25,000 in the donor advised fund, if it grows from 25 to 50,000, I don't get to write off that $25,000 as it goes up. I get the first $25,000 write-off, but I don't get any more. So it's important that we, in my opinion, that you have the money kind of stay in your account to kind of get the appreciation. And then we want to start donating it. Then we move that over to the donor advised fund. And by doing it that way, it allows us to get that big old tax write-off. So we put in $25,000 in a stock portfolio. Now it's worth 50. So as they put it into it, it's no capital gains tax, right? So even though it's quote unquote being sold, it's no capital gains tax because it's going directly to the donor advised fund. So they're not paying taxes on the sale. It's just being moved over. They get to deduct the full $50,000. They don't deduct the $25,000 that they bought it for. They deduct the full $50,000 worth today. So theoretically speaking, in their case, because they're retired, they make about $80,000. $80,000 with a $50,000 deduction, that decreases their tax liability from $80,000 to $30,000. I mean, that's a lot of tax savings and money they get back from a tax standpoint by doing the donor advised fund. And then they want to give it to their local church. So this is going to be part of their tithe every year, right? And so they're going to give about $5,000 to their church. Now you can give it to a church, a school, a nonprofit. If you want to be creative, you can kind of set up your own 501c3. Again, we have to have a conversation personally on how you can do it. If you want to be creative, you set up your own 501c3. If it's a registered charity, then you can actually move that money so we get a tax write-off, right? And then give it to the donor advises the fund, donor advised fund, to give it to that 501c through that charity. We know from a tax standpoint, we have none. So it's definitely ways that you can definitely help yourself if you want to, or help others. But for them, they give it to their church, and they don't want to give all $50,000 to the church at one time. So they said they're going to give, $5,000 a year to the church. So again, it's a way for you if you have money. that you want to give away, but you want to have a way to get an immediate tax benefit because of it, you want to do the donor advised fund. And since it's in your name and you're able to advise it, you still have all the power to make decisions on how the money's invested and who gets the money, compared to a charitable trust where all the power is gone. So again, that's a way for you to keep the power, get all the write-offs using a donor advised fund. And with the big, beautiful bill, you're now able to kind of have that wiggle room. So any questions on a donor advised fund? How this fund works? Has anybody used a donor advised fund before? You guys can put a 1 in the chat if you guys have used a donor advised fund, or if you have a donor advised fund for yourself. I imagine a few of my clients here would say so, but just in general. Okay, no, this education then, yeah. So definitely for people that do not have a donor advised fund, especially for you guys that are giving money, especially to the church from a type for offering standpoint, it's a way for you guys to get more tax deductions, right? Because typically, when we tithe, we're doing whatever percentage we are, like on like a month to month, week to week, or month to month basis. But if you set it up in a donor advised fund, have it invested, kind of grow over the year, and then those earnings put into the donor advised fund and give it to the church at the end of the year, you just get write-offs. So let's just say, for instance, to make up we're doing $100 a week, right? $100 a week, each week to our church. Once we do that, that $100 is write-off, right? But what if we did that $100 in the donor advised fund every single week? And then, of course, over time it grows. So for the year, at that $100 a month, which is basically $5,000 a year, that $5,000 now turns into $8,000 because we have market appreciation. Now, instead of writing off $5,000, I'm writing off $8,000, right? So this allows you to kind of have more write-offs because you take advantage of market appreciation. So and that's what we do. Like we definitely tie through our church, but we tie through our church via a donor advised fund. So we put money in literally on a week-to-week basis. That money grows, mostly in cryptocurrency, and in our aggressive portfolio, because I am, of course, aggressive, right? And so then at the end of the year, it's just a lot more money we're able to write off because we did it through the donor advised fund compared to doing it to our church impact here in Jacksonville on a week-to-week basis.